All right. Good morning, everybody. Seems like I'm a few minutes late. It's been a morning. Had some Discord issues, but we're back now. All right. You should be able to see the main screen. Just got to change some permissions here. All right. So hopefully y'all had a good weekend. I I bought my first motorcycle over the weekend, so that was exciting. And I actually got to meet one of my neighbors. I've lived in my town for over a decade, and I'm a little bit of an antisocial jerk, so I don't know most of the people that I live around. But thanks to my motorcycle, I met my neighbors. Ah, funny how that works. Nobody cares, right? Just get to it, Sig. If you're new, I'm Sig. European market wrap. What happened while we were sleeping? We got the dollar still up from Friday's levels that actually maintained. And as I'm speaking, it's trying to test yet again another breakout. Keep your eye on that thing, right? I'm telling you, the dollar and the bonds, it is impactful, right? So what we're looking at is financial juice. The goal of these morning briefings is to teach you how to do morning briefings, right? I'm not trying to give you a fish, I'm trying to teach you how to fish. This is a free resource and it's a really valuable resource. It gives you a clue about what happened while you were sleeping, and it's a pretty decent heads up for game changing news through the day. If you don't yet use Finance Juice, find a way to use it. It'll make your life easier, right? So we're looking at what happened over in Europe last night. If I was to scroll back far enough, it would show what happened in Asia last night as well. And after the close today, it will show what happened in the US. So if you see a move on the intraday market and you're thinking, why did that move happen? I don't get it. I don't see any news. Sometimes it's not like headline news that changes the market, and we only find out later on. So this is a good source to circle back at the end of the day and kind of ask what happened. So we're just kind of looking around. You want to look for anything that might stand out and or last into today's action, and you want to kind of look at this in the overnight hours and ask, did something already happen? I mean, we're going to get to the charts, but you'll notice not a whole lot happened, right? So just a nice little heads up place. The other one that I like to go to in the morning is called Koifin. This used to be free. It's not free anymore, or I should say most of it is not free anymore. They do have a little bit on the free side. I'm using the free side right now. The free side is all we need because you can go to market news and then it has these tabs. So if we want to look at world economy news, if we want to look at news that directly affects different industries, corporate events, global markets, or just straight up top news of the day, keep your eye on the sidebar though, because they don't make a distinction between old news and new news. So this morning, for an example, if we look at Asia Pacific markets, the first three are today's news, but then anything beyond that is from like last Friday. So if you're not careful, you can just sit here scrolling and thinking, wow, you're reading all this news. And it was just those last three. I can tell you, I've done that. So if I've done it, one of you are going to do it eventually. We just really want to look at some headlines, right? We're not trying to read articles. This will point you to different places. You can click the link and maybe, fall down the rabbit hole. We just want to check the headlines. Is there anything that really stands out? Anything that we need to know about? And if not, then we move on. It also has its own little built-in tweet place. So it's going out to Twitter and it's grabbing what it considers the most influential or impactful Twitter. I think the one that I built to monitor Twitter does a better job than theirs, but hey, maybe it's just because I've got a big hit. So nothing's really standing out on the night news, but we at least wanted to look. Okay, so from there, boom, boom, boom. We bring it over to Thinkorswim and go to Market Watch. I like to put the description next to the time of day so it's easy to read. If you're looking at your Market Watch and it is cluttered and full of crap like this, And you say, hold on, man, I can't see it. It's all this other stuff is in the way. Yeah. Hit the show all and turn everything off, and then go back in and just turn on the events. Now you can see the ones that are important. This is an FOMC week, by the way. So it is likely to, well, on a normal FOMC week, it would be likely to be kind of sideways, a little choppy. We would all be on pause, kind of waiting for the Fed. I don't think this is going to be a normal week. So, yeah, there's that. It looked like we were getting a little bit of a dead cat bounce. Before we actually get into the charts, though, the time frames are important here: 9:45, 10 o'clock, and 11:30. These additional auctions at 11:30, they are game changers. Pay attention to the clock. If we have a sideways morning, that sideways morning could end right around 11:30 when these auctions come out. If we've been trending, these could kill the trend. So if we've range bound, it can put us into a trend. If we've been in a trend, it can kill it. If you go back and check where there were additional auctions and then look at the midday price action corresponding to those auctions, you'll see why I focus on them so much. One of the really good things about doing these morning briefings is you've got over 6 months where we came in every morning and we looked to see what kind of econo events were there. So if you were to do the grind and go back and watch every previous morning briefing and see if there was additional auctions and then pair that with the move that came through the day at those auctions, you wouldn't have to worry about trusting me when I tell you they are impactful. Watch the clock. Y- If you go and do all that work, you will realize after all your efforts that they are something you absolutely do want to watch for. They are important. They're game changers. It looked like we were going to get a little bit of a dead cat bounce, and now it's fading back out again. Bitcoin actually gave us the heads up so that we didn't try to take the rally. What is a dead cat bounce? I hear it all the time. What is that? Well, in a trend, when you got a pullback, and then you have a trend, and you have a pullback, and you have a trend, and you have a pullback. Is it really just a pullback, or are we actually beginning to perhaps change direction? So the pullback is really important. It's what people talk about all the time. And along the way, somebody named that pullback in a trend a dead cat bounce. I don't know why. Kind of sour and a little gross to me, but whatever. It's just a pullback. Well, we can't call it a pullback, right? Because pullback in what? In a trend, and then it becomes this whole conversation, right? It's like, why did I name something Busby? Because trying to explain what Busby does takes up too many words when you could just say, oh, it was a Busby. And as long as everybody knows what a Busby is, we're good to go. Well, that's just a dead cat bounce. As long as everybody knows about a dead cat bounce, we're good to go. So what have we been doing? Well, we got this move to the downside. We had a nice clean price action on Friday, and then now we're pulling back. So it's a part of the same old discussion. Is this just a pullback, or are we perhaps going to base and turn around and start going the other way? Well, right now we have the base. We started to come out of that base, and now we broke it. One thing that we would need to see if this was just a If this was just a pullback, then we would need to see lower lows, right? We need to see this actually continue. We don't want to see it sit here, linger and linger and linger. Because think about what a trend is supposed to do, right? Trend is very uniform, it's very specific, it's very unique, and it's actually specifically measured, like stairs is the analogy that I use. For any of you that don't know, you can't just make stairs whatever size you want to make stairs. When you tread from one step to the next step, that distance has to be uniform. Now, you can choose to make it 6 inches, 8 inches, 10 inches. There's a distance that you can't go beyond, but whatever size you choose, it's really on you. If you want a 5 inch step, you can make a 5 inch step, but you can't make the next step 7 inches. If you pick five, they all have to be five. Why am I talking about stairs? Well, trend is the same way. When you have a good, clean trend, it's uniform. The more uniform the trend, the more powerful the trend is. The more you can trust it, the more money you can make on it, the more it's validated. So when a trend is very clean and it's very clear and every pullback is uniform and specific and unique, That's a money making machine. When it fails to do that, when it starts to go too far, that's a warning. It's telling you, right? It's capitulation, or if it was at the tops, it'd be blow off top. It went too far, and it's a huge warning. If it had made the pullback and it didn't go very far, it didn't match the same impulses from the previous moves, that is a warning. So when a trend begins to fall apart, it's a huge warning. And it's easy to see once you realize that it's supposed to be uniform. It's supposed to be very, very specific and unique. So when we got to these lows and we began the pullback, where is everybody? Where's all the sellers? If this was going to continue in the trend, if this was going to continue with the motion in the ocean, why are we paused, consolidating, bunched up like a bunch of asparagus? Because the trend is dead. Now, the trend can come back again. A dead trend can be revived and continue moving in the same direction. It can, absolutely. Yes. But the trend that we had on Friday is gone. That trend is dead and done and over with. And we, until the last few minutes, had just been consolidating, getting these lower or these higher lows. So we were actually trying to heal and work on getting that base built for an eventual cup, and then have maybe a handle on the cup. Now we're breaking lows, and looks like we're going to retest the previous lows, and so a new trend could begin to the downside, keeping that motion in the ocean. We could base here and spend the rest of the day along these lows, but that old trend is dead. Important to recognize that this is no longer a pullback in this trend. It is something else now. Of course, if you get onto a high enough time frame, then it's still just a pullback. Trend is validated from your highest time frame coming down into your lower time frames, and reversals are validated from your lowest time frame moving up. And it's our job to kind of find the middle ground there, high enough up to recognize where in the trend we belong, and then yet low enough to be able to spot when those trends are ending and reversals are coming. It's a difficult thing. Everybody struggles with that time. Good luck. Just be patient with it, right? Pick a time frame, use it for a couple weeks or maybe a couple months, and by the end of that time frame, you'll know if it's one you like. If you don't like it, use a different one. There's no perfect or right time frame that I could give you because nobody can do that, right? Only you can pick your time frame. This is all going to be data driven this morning. There's an old market logic that says everything you need to know is in the candles, so you don't have to worry about news. I've never quite agreed with that because, well, new news happens constantly, and that new news can move the market. But there's the argument that says you don't need to know, say, what Apple's earnings was. All you have to do is look at the candles after the earnings, and you'll know, was it good earnings or was it bad? Everything that you would need to know is priced in. Now, this isn't my logic, right? This isn't my argument. I'm not the one who's advocating for this. I'm just telling you that news is priced in. Over the weekend, we have a dead spot where price is not getting the news. And so on Monday morning, when the bell rings at 9:30, we start pricing in all of that news from the weekend that we didn't have yet. It doesn't matter that we opened last night at 6 o'clock in the Globex. That Globex price action was not pricing in American news in our markets. And that's because the futures are directly connected to the SPX, and the SPX is only open from 9:30 to 4. So it can't price in that news because it hasn't opened yet. And since these are futures based on that, then this futures market hasn't priced in the news from the weekend. Every Monday, we have to price in this news. It can take 45 minutes, it could take 2 hours. Doesn't matter. So we can start out really bearish and turn bullish. We could start out really bullish and turn bearish. We could just stay sideways all day. The point is, in the first 30 minutes to an hour on a Monday, you always have to be ready to see that news get priced into the market. And so watch for head fakes, watch for reversals. For this morning, like we do every single morning, starting with the ES, asking a simple question. What's more likely? Three scenarios. We stay ranged, we run high, we run low. That's the only three things the market can do. So, what's more likely out of those three? That we stay range bound? Well, what is the range? It's really not easy to answer that question on if we are going to stay range bound or not if we don't know what range we're talking about. So, the range that we're going to define is the Globex high and the Globex low of our current market situation, right? From Sunday night. That'd be 4160 to 4120. Could we stay in this range for the day and not do anything else? Yes, we could. Absolutely. I find it very, very unlikely that we would do that. So I would extend the range all the way up to Friday's price action, Friday's high. Right now, we are on an inside day. The price right now is still inside of Friday's price action. So we are inside day. If we break through the bottom of this area at 4116, then we will no longer be inside day. We'll have an inside day breakout to the downside. So any move to the upside from our current location will be nothing more than maintaining yesterday's price action, staying inside the range, which would form like a bit of a V or a micro cup and handle. There's plenty of room. It'll probably take days to climb back up that ladder to 4170 or 4270, excuse me. So it'd probably take a long time to get back up there. But could we begin the process today? Maybe break out of the top, break out of our own Globex high of 4160 and begin that reciprocation back up from there. Yes, we could. That would be scenario two. So scenario one would be I think we're going to stay range bound within our Globex. Yeah, good luck with that. Scenario two would be that we begin the reciprocation process and we begin moving back up through Friday's levels. And then scenario three would be that we break through this low and make new lows from here. We're going to stick with the top side scenario for a few more minutes. How far away could we expect price to go today? Now we had a record move Friday, over 3.5% in the S&P. It's made bigger moves than that before, but that's a pretty significant move. Most of the time, if we're having a quote good trend, you'll see something like two, maybe two and a quarter. Anything beyond two and a half starts to get us into wow mode on the ES. Right. So Friday was a heck of a wow mode day. 2 to 2.5 is about normal. Our current ADR right now is 2.1, maybe 2.2. This is percentage. So if we're basically flat now, we could measure a 2% move to the upside, and that would get us right around the cog line of 42.11. Is it spot on perfect? No, I kind of hedged that a little bit, but 42.11, the cog line, that would be my upside target for a normal day. We wouldn't even have to be like, whoa, that would just be a normal day. 2%. Why is it normal? Well, for the last 21 days, our average price move per day is around 2%. Now, obviously, yesterday's or Friday's move increased that number significantly because we were below two. We were at like 1.9 or maybe 1.89, something like that. But it is an aggregate of the last 20 days. What have we been doing? Well, on a day to day basis, we've been moving around on average 2%. So asking for a 2% move today, it's not it's not a large ask, right? I'm not overreaching. After we make exaggerated moves like we had yesterday, it very, very often causes us to rebound and move in the other direction. That's what price does. It's linear regression, mean reversion, coming back to the midpoint. It's all of those things, any of those things, dot plot statistics and least squared methods. It doesn't matter if you understand the math behind it. It just matters that when you see price make very big, long, sweeping moves like that, it very often uh, recycles or reciprocates or comes back in the other direction, right? It pulls back, not because it necessarily wants to, but because liquidity vacuums in volume nodes. So we talked about the upside. We talked about staying in the range. Let's talk about the downside. From our current location, put a 2% move on this market, and it does not get us down to 4,000, which is good, kind of. But it does get us around 4140. So a 4140 to the downside for a 2% move. Let's add some levels in here, right? Something with a little bit of distance and target to it. You could use Fibonacci, but every time I do it, I get a lot of emails from people. So let's use the quant tool. Where is that? If you look down here, it's a new tool that Thinkorswim added called the Quadrant Lines. It's pretty neat. You can use this for anything: head and shoulders, ranges, flags, channels, everything. Right? So we want to use that. We're going to mark from Friday's high to Friday's low, or actually from Friday's low to Friday's high, since the thing we want that line right there. That line is 50% of what I just measured. Notice it ties exactly with our 2% measurement that we were just talking about. That's called confluence. When you can take something that you analyzed using one set of tools and it lines up with your analysis from another set of tools, you have confluence. Right? We got to that same answer using more than one set of data, which is really cool. It also is another way to validate that, yep, we're not just randomly drawing crap on the screen, it fits. Cool. What else you got? Well, we're going to skip fib in this situation, but we could use maybe one more set of lines, and that would focus on the Globex itself, from the Globex low to our current Globex high. And again, it marks the 50% mark, it marks the 100% mark, and then our old mark is still there. So now we've got target 1, target 2, and target 3, just like that. Simple, easy, effective, and you didn't have to use something confusing like Fibonacci. Right? I don't think Fibonacci is confusing, but the world thinks Fibonacci is confusing. Oh, don't want those. So we're looking at the volume profile right here. This is a 10-day, 30-minute. Corey Rosenblum made this time frame popular. In blue, we've got TPO, and in green, we've got volume. So this is volume by time and volume by price. You can see that we are at the value area low, and we're threatening to break to the downside there. There's nothing below that because that is the edge of the volume profile. So this isn't offering us any perspective to the downside. I'd also add that when we normally use volume profile, when we get to the edge, we expect it to find some support there. Remember that support is not a line in the sand, right? It's not a specific dollar penny amount. Support is an area or a zone. So when you see price get down to an area or a zone and it doesn't stop to the tick penny perfect with some line that you drew, don't automatically assume that it failed. Right? You have to give things a little bit of room before you say it broke support or resistance for that matter. Price can't see your line. If we leave this box, which we literally are leaving the box as I speak, and we continue to move farther away from the box, that holds a lot of weight. It is significant. It takes a lot of pressure to move price out of this box. To continue the move farther and farther and farther away from the box takes even more pressure. I shouldn't have pushed that button. That sucks. Good thing I keep that stuff saved. All right, so this is a little bit different, but kind of the same. It's a volume profile, but it's looking over the last 5 days. Each day has its own volume profile. We want to carry those profiles forward into our day. So when we look back over the last 4 days, 5 days, we want to look at things like the value area high. We want to look at where the point of control was and the value area low. We would extend those forward on the belief or the idea that if price was to interact with those, there would be a reaction in the market. Friday did a reasonably decent job of showing us that, right? There was a pretty decent example. If you were to carry, the value area from Friday forward or from Thursday into Friday, price did interact at those levels, or the point of control price did interact there, but they weren't very clean. I look at that and I think I wouldn't have traded it. And if you had tried to trade it, it probably would have ran you over, right? But you could have been recognizing that we were coming into a point of control and had been prepared for a bounce. Whether it actually did bounce or not is a different thing, right? But that's what the kind of stuff that we would be looking for. Same thing for today. Now, if you find one that is what we call untouched, the only ones that I deal with that are untouched are point of control, but we don't have an untouched point of control here. We do have an untouched value area. So if I had extended that value area and we have not yet come back and hit it since the day we left, then we consider that untouched, take this and maybe set it on 30 days. We'll find an example. How many profiles do I want? 31, because I just did 30 days. Come on, give me. All right, so there's one. So here's a POC that we have not yet come back and made contact with. So this is an untouched point of control. And it doesn't matter that it's 2 weeks old. We will come back through that level, right? The S&P will not stay down forever. We will eventually start moving to the upside. And when we do, this untouched point of control, it will be there, right? We want to know where it is and have an expectation that when price comes into contact with that line, that we'll see a reaction in the market. A lot of places use this kind of logic, especially if you get into like TPO charts. Um, yeah, so it's just what we do, right? But what you want to do is like put them on their own layer. Otherwise, you'll just have a collection of lines that are always in your face all the time, kind of distract you and get in the way. Okay, so that deals with the S&P. Take it over and do the same thing with the Nasdaq. The Nasdaq did not wait. It's already made that break to the downside. It's continuing to make that move. Last night was watching that wedge on the S&P, trying to see, where we're going to break to the upside, where we're going to break to the downside, and then it broke to the downside just enough to catch everybody, and then it rallied back up and ran us all over. Right, that wedge. In the ES, it was more symmetrical. Nice little breakdown and then rally back up. It did a little head fake. What do we got for the day? Well, we've already started making that move to the downside. Nothing says that it's going to stick yet. We want to see it connected with news. Um, After the exaggerated move that we already had, the idea that we could go lower without getting the rebound is a little bit of a surprise, but we do know that it can do that, right? We don't ever want to say that, like, oh, it can't do that. Um, yeah, it depends on which platform you use. So if you're on Thinkorswim and you bring up a TPO chart, it should already have that for you. But if you're on, say, I don't know, some other broker, hard to say if it will automatically do that. Now, if you draw a volume profile, it will automatically give you the point of control, right? So, I mean, on your own. But a volume profile is not a POC. Yeah, I think I broke Thinkorswim. I was going to show you this is a footprint chart of the ES, but Thinkorswim's acting a little wonky. There it is. It got around to it. It just needed a few minutes. On Thinkorswim, it's called a footprint chart instead of a TPO. But you can see how it automatically defined the point of control. We don't trade with these, so anybody that's like, "Oh my gosh, I got to go get that. I'm going to use that in trading." No, it's a 30-minute default time frame. It's used for analysis, not for trading. Right? So we don't trade with these things. And when you put a chart up like this, you get time and price, right? Just like we were looking at with the volume profile, and this confuses people. So if you just go and look at what we use every day, it's so much easier, right? Because this is also 30-minute. And this isn't some crazy profile that drives everybody nuts with ABCDs, and instead you have candles. So just to save you from going crazy, using something like this gives you the same thing: volume by time, volume by price, and candles, which helps make sense, right? At least while you're learning. Once you learn a TPO, you'll realize, it's not that bad. It's nothing to it. It's just yet one other thing that that you can learn. And you don't have to have it. It just helps, right? So the Nasdaq, come out to the daily chart and take a look at what we got. We had a bounce off of the bottom of the 10-period daily moving average in a lot of markets last week going into Thursday and Friday. We had a lot of markets reject on that 10-period daily moving average. So for an example, if I was to load a 10-period on this daily chart, you can see that blue line. Some of our biggest names came up and hit the bottom of that 10-period moving average and rejected off of it to the downside. A perfect technical analysis bounce. That's why we constantly ask, how far away from the 10 are we? And it's why I built the indicator distance from moving average. The 10-period daily and the 10-period weekly are really important to keep track of. Investors Business Daily leans really heavy into a 10-week, which is almost like a 50-day moving average. It's kind of close. Each market extends from its 10 a certain distance before it considers that to be too far and it pauses there. Think of the 10-period moving average as a gravity point on a daily chart and how far away we bounce when you've seen Neil Armstrong on the moon. He's bouncing around, but he would still keep coming back down again, right? He would be on the moon bouncing around and get pretty high up, but he'd still come back down to the moon. Well, that 10 would be the surface. We can bounce away from it. We can cross through it and go to the other side of it. But eventually, once we start extending too far beyond it, we're going to pause there and come back. If you're really old and you remember the paddle with the string and the ball on the end of it, it didn't matter how hard you whacked that thing, you could send the ball a long, long ways away, but eventually it was coming back to you. Right? Well, it's the same thing with this 10. If you look at the 10 on a daily and a weekly, how far away from the 10 we get is really important. And when we extend too far beyond that, we pause there or we turn around and come back. Each market is a different distance for what is considered too far. For the Nasdaq, around 6% on a daily time frame. If we get beyond the more than 6% beyond the 10-period moving average, that's a bit much. And the market tends to pause there or reverse. The other day, when we went extreme to the downside in the Nasdaq, we were a long ways away from that 10, but we pulled back. And now we're not very far away from that 10 compared to what we were. This is showing that we have plenty of room to go to the downside here. Right? We can see right now we're only at like a 4, and the other day we were at a 6. So there's plenty of room for the Nasdaq to continue to go lower. Friday was not too far, too fast. It's a simple way, simple, right? It keeps our emotions out of it. It no longer matters what we think, what we feel. We can just point to the numbers and say, no, this isn't extreme. We hit extreme the other day. There's plenty of room here. Those two indicators are in the Thinkorswim Discord, by the way, if you want them, because I don't sell indicators. If I make an indicator, I give it away. I make my living from trading, not from selling indicators. It does help to keep track of those 10-period moving averages on a daily chart. Depending on your broker, you might not have the ability to do that. So mark the 10 on the daily with a line and then come back into the smaller time frame. That line is close enough to the 10 to be a representation of the 10-period daily, even on a platform that doesn't let you see that 10-period daily on an intraday chart. Simple stuff works. For the Nasdaq, what could we do? Well, we could maintain the range, although, I mean, honestly, we've already broke it. But that would be theory number one. We just hold the range. Theory two would be that we reciprocate back up to the previous levels, and theory three would be that we continue to move to the downside. we don't know all the things that are going to come out this morning. We still have to price in all the news from the weekend. So we can't say with any certainty or definitive statements that we think it's going to go down from here or we think it's going to go up from here. There's a lot of tools that we could look at that kind of gives us a little bit of a bias that says, I think it's going to go up from here or down from here. And those tools generally work really good in a market that's not COVID and war and all the things that are happening right now. Right. So in the current market environment, technical analysis comes second to news. And that's just the way it is right now. And the news has been very impactful and nonstop. It just continues to come at us and come at us. One thing that we can say is the Fed is in silent mode. So we shouldn't be hearing from them jerks anymore until the FOMC day. And they've been throwing grenades at this market like crazy, trying to get it to go down. So maybe the lack of them coming in there, chipping their teeth might give us a little pause. But there's some really big names headed to the downside, and that's what took us with it. When I showed my Google targets and my Amazon targets like a week and a half ago or 2 weeks ago, and I had my trades on the chart, it was down at these levels. Of course, we're talking about, 2 weeks ago, so it still looked like this. Everybody said, "Oh, yeah, we're not going to go down there. Are you crazy? That's too far away." Uh-huh. Yeah, not so much. Say that to PayPal. Say that to Facebook or Spotify. Not too far away. Netflix. It's not too far away. So when you get back into something like Google, Nvidia, Apple, Microsoft, there's a long, long ways to go if this market is going to beat down some of these names that are just way overextended. And the good thing is, putting on some spreads in these things, 50 points wide or 100 points wide for about $3 of risk, that's not that bad. You're talking about risking $3 to make 25, 35, 45, right? And of course, $3 means $300 when we move the decimal point in options. All right, so for the upside move in the Nasdaq, we would first need to reclaim our Globex high. That would put us at 12,980 12,986, right below that 13. Should we get through our own Globex high, we've got an area at 13,025 that needs to be dealt with. 13,175. And I need to see where that open was. And the open at 13,250. That's the gapped down open Friday, well, Thursday night into Friday morning, right? We basically call it Friday's Globex. I don't think we're going to need it, but 13.3 would put us at the close, the 4 p.m. close of Thursday, right? And that's that gap. We really want to focus on that gap. I know it's been closed. We closed the gap. It's no longer a gap, right? Focus on it anyways. Beyond that, we have a Globex high from Friday, and that ties in really close to Friday's RTH high. So all of those levels to the upside. Plenty of things that if we were to start moving in that direction, that we're likely to bounce off of, take rejections from, and interact with. To the downside, clear sailing all the way down, right? We can go and look at the volume profile, but we're at the bottom of the volume profile and there's nothing below it. So there's not really a whole lot we can see that's going to be valuable from this chart time frame. We could take it over to the 5-day, 5-minute, but again, not a whole lot to see here because there's nothing down there for us to look at. So those two really aren't going to provide much context for if we break to the downside, where are we going? Instead, we have to come back in and use our own metrics from in here. So the quant tool again, start at the low, take it up to Friday's high. That gives you your 50%, which is 12.5, and 100%, which is 12.2. Those are the extremes. We want one a little bit smaller, right? Because not everybody wants to take a duration trade through the day. We want to be a little more nimble, get in and get out, maybe get in again and get out. So from the low to the Globex high of today, that gives us something with a little more, a little closer in. That would be 12,720 and 12,630 ish, really close into those areas. The current ADR on the Nasdaq is 3.25. We are down a 0.5% this morning, so we easily could go 2.75 to the downside from here. A 2.25 would put us at 1.5. So that's not too far away. If you're looking at that distance and thinking, oh man, you're kind of stretching it, that is well within our boundaries. We could easily make that move. The question becomes, are we going to make that move? Are we going down from here or are we going up from here? I mentioned earlier Bitcoin gave us the heads up. It started to make this break to the downside before the S&P and the Nasdaq started to make this break to the downside. Was that a coincidence? Nope. It's been doing that lately. In the last week or two, I've been keeping my eye on the Bitcoin constantly. We're looking for not the little micro changes, right? We're not looking at like candle by candle by candle analysis. It's more looking structurally what's going on in Bitcoin. Is it breaking to new highs? Is it consolidating along a package? Is it sitting at the lows of its price area, right? And then if it's sitting at those lows, is it getting ready to break out, break down? If we start to see that breakdown, I start looking at where the S&P and the Nasdaq are. Are they near the same area, near the same lows, ready to make the same breakdown? Right. So uh, it's just one more tool, one more bit of information that we use for validation and confirmation. It's not like I'm going to go in there and take a trade just because Bitcoin broke to the downside. No. But if I see Bitcoin breaking to the downside, to the upside, doesn't matter where it's breaking. If I see it starting to make a break, I start looking for the opportunity in either the Nasdaq or the S&P. Right. So, for an example, Friday, Netflix or Bitcoin had that liquidation break, and um, the S&P and the Nasdaq actually pulled back a little bit before continuing that move to the downside. So, a perfect example that we don't want to see a move in Bitcoin and automatically assume like, oh yeah, we're going to make the same move now. Nope, got to give it a little time. But that was a precursor, a warning, a heads up that the move to the downside wasn't done. We're kind of maintaining the range in the bonds. We're looking at the 30 right there, but let's jump over to the 10. So a tight consolidation along the lows, and we broke out of that and are now maintaining above that consolidation, but we're still not really going anywhere at the moment. The bonds and the dollar open at 8 and 820, so they are like an early morning on our day, kind of give us a feel for the way things are moving. We got the dollar sitting near its highs, not at the highs, near its highs of the zone or the area we've been using. And the bonds are sitting in its lows, a lot like the Nasdaq and the S&P. Healthier than these, certainly, but bonds came down Friday, just like the S&P and the Nasdaq came down, right? So we say the S&P and the Nasdaq, we just put them in a back and we say stock. Stocks went down Friday, bonds went down Friday. Now, bonds are trying to come up off of those lows, as was stock, but stock failed to keep it and started to give it back again, while bonds did not. Bonds are still bid up compared to its counterparts, but still down on the day. All right, so weakness in bonds, weakness in stock, the dollar sitting up near the top of its zone, weakness in oil. Notice Friday, oil ended down too, right? So oil was down, stocks were down, bonds were down, gold maintained. It was off of its high, true. I mean, it did set a high before the open, and it faded off a bit, but otherwise it kept that range through the day. I thought gold did pretty good surviving Friday compared to everything else that was going on out there. Watch for that to change, right? You can see how gold's just really been getting the beat down. It's getting a move now like the rest of the market had Friday. So sure, it maintained for the day, but since then, it's been giving it all away. So you could look at it like it's just getting caught up and moving to where it should have moved Friday. Yeah. Uh-huh. This is all a part of what we watch and why we watch it, how it provides context and opportunity and validation for the things that we are seeing move in the market. All right, we're looking at the sectors this morning. Um, I want to see them up or down or have moved in some way, at least a half of a percent. So all of these names that are sitting at like a tenth of a percent or 2/10, that's not enough. I want to see at least 5/10, a half of a percent, right? So gold down more than one, energy is down more than one, marijuana, energy, energy. Semiconductors also down 3/4 of a percent. Technology down at half. Emerging markets is also down. We use this for a global gauge. Where's the sentiment in the global marketplace? If we were in a risk on mood, we would expect that to be positive. If we're in a risk off mood, we expect it to be negative. It's slightly negative. So it is negative, it is down, but not impactfully so. S&P and IWM are also slightly down. So then we start looking in the other direction. What's positive this morning? You know, again, it needs to be up at least a half of a percent before we really want to focus on it. So what hasn't made that yet? Utilities, building materials, those are slightly up, but not enough. Finance and consumer spending up, but not enough. So we get past that and start getting into, well, what is up enough? IGM, this is an expanded technology ETF. It's basically tech, but the large tech. Then there's industrials, Bitcoin, and some banks. Now, notice the banks are up 3%, but XLF is down or slightly down. That's because you can't paint with a broad brush and say, oh, finance. So, what do we want to do with this? Well, energy and finance were really greatly correlated all through last year and a little bit into this year. I want to look for that correlation to stick or to break. Friday, we were really correlated across the cap in everything, right? If you look around Friday, everything was going down. Anything that wasn't would be what you would want to target today for a move down, right? So if it was positive Friday, try to short it today. I would say anything that was negative Friday, try to go upside, but that's too broad of a blanket, right? Don't do that. But start with that premise that anything that was doing good Friday, if we're going to get that reciprocation today and like flip the market back over, anything that was doing good Friday would get beat down today. And anything that did bad Friday would probably get a dead cat bounce today. Probablys aren't a really good way to approach the market, though, right? Look at what's up in the pre market, approach it from that point of view, what sector, industry, sub industry, and then follow it down the rabbit hole. What we've been getting a lot is that first 30-minute bump to the upside, and then we roll over and dump it down on their heads, right? So in that first 30 minutes, be looking for that fake out. That's your opportunity. Things that are up in the pre-market, say 1%, those may be the ones that roll over the best on a downside move today. I don't like shorting from the hole, right? So when we open and we're sitting at like the low of the range, I would rather sit out or buy the low of that range than try to sell the low of the range. Short from the hole. course, you miss opportunities by having a set of rules like that, but they're my rules. It's my money. I'll trade how I want. If you want to short from the lows, have some form of money management that will allow you to lose frequently and still be positive, right? Because it's not about how often you win and lose. It's how you manage the money on your losers and winners. A butterfly strategy, for an example, loses 90% of the time. Imagine that. The butterfly loses 90%. Then how come everybody loves the butterfly? It's not because of its win rate. It only wins 10%. But when you do win with a butterfly, it's one hell of a money win. And when you lose, it's a really, really small, tiny fraction of a loss. So really small losses, really big wins. It's the perfect example of trying to grasp the logic that winning all the time is not the goal, right? This isn't a video game or a scorecard where we're trying to have the most wins. Be prepared for that fake out shakeout today. Remember that the financials and technology are needed if we're going to see a rally in the S&P and the Nasdaq. Without those two sectors, one or the other, we won't get the rally. Even if we do get both of those sectors, there's still no guarantee that we will get the rally, right? And that's basically coming down to the fact that the fangs can take control, and even without having the help of the sectors, the fangs can keep us down or continue in that rally, right? So if you look at the advancing versus the declining line in the Nasdaq, we went into the close with advance versus decline at minus 88. That's 88 out of 100. If you look at the S&P 500, the advance versus decline, we went into the close at minus 478. So we were really, really, really correlated Friday. Everywhere you looked, everything was all doing the same thing. High correlated market. As I've said before, and I'll continue to say it, a highly correlated market is a very, very dangerous market. Well, we may see that same correlation come in today with a reciprocation back the other direction, right? Because if everything fell an exaggerated distance yesterday, then it's very likely in the dead cat bounce today that most of those fallen names will reciprocate back to the upside. It doesn't make them straight up long-term buys, right? But in a dead cat bounce, we play what we get, that small 1 or 2% move to the upside, and then we roll it back over again. Remember that some of the greatest moves to the upside, intraday rally days, some of those biggest in history happened during bear markets, not bull markets. And the reason why should be pretty obvious. It fits the earlier statement. I'd rather buy from the lows than buy from the highs. So some of the biggest up moves in history has come in a bear market when we were at lows and everybody started buying, not when we're sitting at highs. So we're looking at the fangs here in the pre-market. Um, I've kind of made adjustments to the fangs because some names don't fit there anymore. The fangs were named fangs to begin with. That little acronym was all put together because of their market weight, right? Well, Facebook and Netflix no longer have the market weight to deserve to be in the list. So they're not in the list. I booted them out. This is my list. I can do whatever I want with it. There are articles online, and there's something called the New York Fang. I think they constantly adjust that. And whoever's doing the adjustments probably has been doing this for 20 years. They have way more experience than me. Maybe look at what's in their fund that they're using for the NYSE Fang and see what makes up their basket. My basket: Tesla, Nvidia, Taiwan Semiconductors, Apple, Microsoft, Amazon, and Google. Now, on my own, when I know that I'm not streaming and none of you are looking, I add in things like Johnson and Johnson. Right? It's got a market cap very close to, say, Nvidia. Right around that 400 area, I believe. And healthcare is one of the three largest sectors that make up the S&P. So it makes perfect sense to me to monitor something like Johnson and Johnson, but it's not one of those sexy tech names, right? And we need tech and finance to rally to see an S&P rally. It wouldn't necessarily be attached to something like, oh, Johnson and Johnson's running. So what? Right? Anyways, diverging. This is my FANG list. When you put all of the names together, you can make your own little homemade ETF because that's the way Thinkorswim rolls. So this chart off to the side here has all of these names in it, except IGB. I didn't add that to the homemade ETF. These FANGs are what can drive and will drive our market. So keep your eye on them through the day. I like to keep my eye on them in aggregate with one symbol, but you can watch their charts individually. I mean, we're trading those charts most of the time, so you're probably watching them anyways. All right, guys, this is what I got for you. Be careful, be safe, have a good morning, and I will see you all. Oh, real quick. Um, I'm very likely going to be streaming this morning in large cap and in futures, both. Just like we would do on Fridays, I'm going to be doing that today. Right. So there probably wouldn't be or won't be a streamer today in the large caps room unless I do this. So I don't want the large caps room to not have a streamer, and I'll just do it myself. Right. So I'm going to post the link for the Zoom on the futures. I will post it into the large caps to let you guys know that, I'm firing up and I'm going live. And I'm fine with covering both. The way that I trade futures and the way that I trade options, they're the same way. Inside day breakouts, IX tens, 5 minute open range, Busby's, same logic applies, right? And I analyze the market the same way to trade both products too. So at the end of the day, to me, it doesn't matter if I'm streaming in large caps or if I'm streaming in futures. The way I approach the trades, there's exactly the same thing. So I'll see y'all at 9:15 ish.